I'm going to show you 7 unbelievable interview tips to help you get the job. So you got to have a lot of frameworks ready when you're answering questions about a model or evaluation. You never have to be right in these interviews. Just sound logical. Have a logical framework. And I love to call this methodology a crutch. And I can give you a couple of examples. You need to fall back on them if you're flustered, okay? Or if you don't know, you don't have enough time to answer the question. You can fall back on that crutch, okay? And so what I'm going to do is I'm going to give you a bunch of answers you can provide that are generic enough that you can include in many answers if you need to. All right, there are 3 portions to this section. Part 1 is quantitative tips that you'll use with models. Part 2 is qualitative tips, which you might use when it comes to M&A. And then part 3 is relationship tips. Okay, there are crutches for each section. Let's kick it off with part 1, quantitative tips or quantitative crutches. And you'll use these frameworks that I'm going to provide you with when answering quantitative questions about IPOs or mergers and acquisition or buying versus building or valuation or modeling. All right, let's kick it off with interview crutch question number 1. Company X is considering buying company Y. How would you analyze this scenario? So you're given this question, you're like, oh my God, where do I start? Right? And by the way, they won't say company X. They'll say Apple's considering acquiring Beats or whatever it is, right? And so rather than being flustered and thinking, oh my God, where do I start? You start with this, right? You ask a question. You say, is company Y a competitor or in a different market, right? And they'll answer the question for you. So if it's a competitor, then you talk about expense synergies, okay? Talk about, headcount synergies. Could they cut people in G&A, S&M, or R&D, and then keep drilling down, okay, until you get to an earnings per share number that's accretive or dilutive. Accretive means it's additive to earnings. Dilutive means it is not. Okay, so if it's a competitor, that's what you get. If it's in a different market, a different type of company, then you talk about revenue synergies, okay? You talk about how Company X can use its existing distribution channels to sell Company Y's products, kind of like how Coca-Cola would sell Dasani water or Monster beverage, that sort of thing. Or Apple would sell Beats. Okay, so again, keep drilling down here until you get to an EPS accretion number or dilution number. Again, accretion means it's additive EPS or vice versa with dilution. Okay, let's move on to interview crutch question number 2. Company X is looking at potentially entering a market by buying or building. How would you advise? This is a tricky one. Okay, so rather than feeling flustered, you immediately launch with this. You ask, what is the total addressable market and the percent of the market that they would like to capture? What is the cost to build and what is the cost to buy? You ask those 4 questions independently, okay? So if it makes sense to build versus buy, okay, then you got to drill down and say, well, is building really cost effective? Does the company have the talent to build? Do they have the existing employees to build? Okay, and how many years will it take for that product they're going to build to be credible, okay, or competitive? And is this really the best use of their capital? Maybe buying back shares would make more sense, okay? Keep that in mind. So what happens if the building of the product fails? And what's the cost to finance it? And what's the impact on the short and long term on EPS? Okay, and stop right there. And what you want to do is you want to remember what the interviewer said when they answered the question on is it the best use of capital. So if they were to buy back shares and you thought that the EPS impact would be way better than building it themselves, then you got to weigh those 2 options, okay? And again, you don't have to be right, but just mention these things and it'll make you sound really good. Okay, that's building. Buying, okay. Is buying cost effective? Is it urgent that this company get this market faster? If so, it makes sense to buy instead of build. And what happens if the deal doesn't work, right? Are there integration issues? And what is the impact on short and long-term earnings? Again, you don't have to have the right answer. They just want to see that you have a framework to use, and I'm providing you with a bunch of crutches. Interview question number 3. We're going to talk about IPO. Company X is considering an IPO. How would you advise? Again, they won't say Company X. They'll say, Uber or Airbnb or some other private company, whatever. Company X is considering an IPO. How would you advise? Immediately, you respond with this. What valuation? Okay. And they might not tell you. They might say, well, you tell me. Okay. And that's okay. All right. So you're either going to go or no go. You're going to go public if the competitor's price earnings multiple, price earnings to growth ratio, or price to revenue multiples are more expensive, right? Okay. So if the competition is more expensive, it makes sense to consider an IPO. And don't just use these multiples I gave you, right? If it's a value investment, don't talk about PEG or price to revenue. Talk about DCF, okay? If it's growth, talk about PEG ratios, price to earnings, or price to revenue, okay? And get a feel for what type of company the acquirer is, if it's a growth company or a value company, okay? You also want to go if the IP market is robust, and you can ask that too, okay? And also you want to go IPO if recent companies in the same sector had successful IPOs. If they crashed and burned, then maybe it makes sense to wait. No go. Don't do the IPO if the competitor's valuation is cheaper than yours with similar growth, right? Cheaper than the valuation that the company wants to use to go public at. Or if the IPO market is really bad, don't go public. Like in late 2008, nobody would go public. Right? And don't go public if recent companies in the same sector had just terrible initial public offerings. Okay, we're done with interview crutch question number 3. Oh, bonus. Oh, they'll love this. Maybe we can test the market by conducting a non-deal roadshow. Remember we covered non-deal roadshows earlier in the investment banking section, right? Oh my God, they'll love you for this. You got to mention this, right? Mention that maybe if we did a non-deal roadshow, we took the management to meet with a number of different institutional investors just to kind of test the waters to see if there's interest in a potential IPO. That's actually a great idea. You'll look smart if you say that. Non-deal roadshow, NDRS. Interview crutch question number 4. Explain how to build a financial model from scratch. They probably won't ask this, but if they do, I want you to have enough logic, okay, to back it up. Or if they ask you to build a model or walk me through how you build a model on LinkedIn or Apple or whatever it is, then you might be flustered, but don't worry because you've got this crutch and you'll kick it off with this. Is this a public or a private company? Okay. All right. If it's public, what you'll do is you'll say this. You'll say, well, I would go and get the model data at sec.gov from the past 10 years using the annual reports being the 10Ks, or the S1 if it was a recent IPO, okay? And I'd also contact investor relations or go to the investor relations portion of that company's website to get the raw data, right? And then I would create the income statement, the balance sheet, and the cash flow statement. I would analyze past trends and forecast the next 5 fiscal years. I'd spend the most time possible on revenue because a lot of items are just a percent of revenue, okay? And then what you do is you also say, is it possible that I could speak with the chief financial officer after I build out my model, just so I can understand if my model assumptions are correct or not, okay? And again, you want to put the CFO at the end there because you want to do your work first, okay? Private, right? So if they tell you this company is a private company, it's a little bit trickier here to model a private company. If you watch the venture capital section of this course later on, you'll see that I show you how to do that, how to model a company that's private. Okay, and there are fewer steps. It's actually easier. Okay, you got to ask you could say, well, can I ask the company for financials? If the person interviewing you says no, right, and they might try to intimidate you, but don't be intimidated. It's just an act. Have fun, enjoy the meeting. Okay, so find out what the TAM is, and remember that means total addressable market. And if you can't get the total addressable market, right, from firms like Gartner or third-party firms, whatever it is, then here's a simple trick. You add up the revenue of the top 25 companies in the world that operate in this sector. Okay, if they're publicly traded, you'll get all that data. And that's close enough. Okay, it's close enough. It won't be 100% accurate, but remember, modeling is often more of an art than a science. Okay, and then you decide what percent of the total addressable market the company is going to have in 10 years, right? So say the TAM is $50 billion and the underlying company tells you, well, we're going to get 10% of that share in a decade. Then, okay, $5 billion is your revenue in 10 years. And you just project sales to get up to that point, okay? I know it sounds a little bit elusive, but you can do it. You basically ask them, how much does the product cost or the service cost that you're offering, and what are the number of units or billable hours if it's a service that you expect every year for the next decade. And if you don't know what to do for percent of sales for each expense item, go to sec.gov to a similar company, find a similar company that's already publicly traded, and look at their trends as a percentage of revenue, each expense item historically, and apply it here. Again, there is no right answer. They just want to see how you think. Interview crutch question number 5. Company X is going public. You need to create a model. Explain to me how DCF works and relative valuation metrics like PE and price to revenue, for example. And there could be EV, EBITDA, and other metrics as well. Okay. Now, they're probably not going to ask you a generic question like this. They'll probably say, its company is Apple or whatever it is. So what you do is you walk through DCF this way. I'm just going to do it generically for you here. This is a crutch, remember? Okay, so for DCF or discounted cash flow, you're going to project the income statement, balance sheet, and cash flow statement. Okay, do it 10 years out. Okay, or 5 years out. Whatever makes most sense to you. If you say 5 and they push back and say no 10, then do 10. It's fine. Okay, and remember, when you're projecting the income statement, you spend most of your time on revenue, and everything else becomes basically a percent of revenue, okay, on the income statement, balance sheet, cash flow statement, etc. Okay, then you're going to calculate free cash flow, which is quite simply EBITDA, right? That's from your income statement, EBITDA minus CapEx, okay? Then you're going to calculate the weighted average cost of capital, which we did in section 2. If you have questions on how to do this, go to section 2, please, the modeling portion of it. Mention the percent of debt and equity for the WACC, and then what is the risk-free rate, market return, and beta, okay? And then you're going to discount 10 years out the free cash flow to today and the terminal value. And you get the terminal value again by taking year 10 free cash flow and multiplying it times 1 plus the growth rate longer term, which is usually 2 or 3% max. And then you divide it by the WACC minus the long-term growth rate, and then discount that back to today, okay? And then you've got price to revenue. So this is just another methodology. And I love using multiple methodologies always to minimize the margin of error. And so with price to revenue, you forecast the income statement out 5 years. You look at revenue in year 5, you apply the appropriate sector revenue multiple, right? Take the competitors, right? Assuming they have a similar growth rate, okay? And then you apply that price to revenue multiple to year 5 revenues or year 10, whatever, if you want to be consistent with the DCF section on the left there. And just discount it back to today. And you discount it back to today using the WACC you calculated in the DCF section. Why would we look at price to revenue? Well, a lot of companies are not profitable when they go public. Okay, so that's why you look at price to revenue. So value investors don't like that stuff, but growth investors and GARP investors more often do. This is my favorite one because less is more. If you have fewer variables in a valuation study or analysis, then there is less margin for error. And so here you forecast the income statement out 5 or 10 years. Look at the non-GAAP EPS in year 5, okay, or year 10. Apply the appropriate sector EPS multiple, okay, and make sure to take into account the EPS growth rate. So if in 5 years, for example, the company is trading at, or the company is growing earnings at 20%, then if you throw a PEG multiple or a price to earnings growth ratio of 1 times on that, that's 20 times. Or you can be more bullish and make it 1.5 times, whatever it is. And there you go. You just apply that multiple to year 5 earnings. Again, we look at 3 different valuation methodologies just to minimize the margin of error. And these are just 3. There's many more, okay? All right. Whoa, what do we have here? More multiples. If you sense your interviewer is a value investor and hates growth investments, then you be a chameleon and use a price to book multiple as well. Maybe. You can also use EBITDA multiples. It's debatable though. It's always wise to value using a couple of methodologies and then again, just take the average. Okay, that's interview crutch question number 5. So let's go on to part 2, which is qualitative tips you can use as a crutch if you're lost, okay? Or if you get flustered, which has happened to me before. Okay, so here you can use the SWOT analysis. You can use a PLC, and I'll explain this in a second. BCG matrix, and then Porter 5 forces, okay? And these are great crutches for you. Okay, Interview crutch question number 6. Company X is considering purchasing company Y. How would you advise X from a qualitative perspective, right? Finance is not just about numbers. It mostly is, but qualitative stuff's important too. Pretend you work for McKinsey in this question. This is actually a lot of fun. So SWOT analysis is one crutch of yours. That's strengths, weaknesses, opportunities, and threats. Okay, there it is there, right? Pretty easy. And then you've got the product lifecycle framework. You can discuss where the product is in the life cycle. Is it in the introductory phase? Is it in the growth phase? Is it in the maturity phase or decline phase? Okay. Bankers love when you have frameworks to talk about. And just keep it simplistic. Less is more. And then you can look at the Boston Consulting Group matrix, right? This is high market share, high growth. That's called a star, which my son Matthew said is a star from Mario. Then you got the cash cow, which means low growth, high market share. This adorable dog, which has low market share and low growth. I don't know why you put a dog there, but it is what it is. And then you got high growth and low market share is a star. Okay, just make sure that use one of these frameworks. It'll make you look intelligent. And then you've got Porter 5 forces as well. And you can see the 5 forces right there. And it's pretty simplistic, but it'll help you from a framework perspective when you're analyzing qualitative tips. Okay, good. We're done with door number 2. All right, let's move on to door number 3, relationship tips. Remember, relationships are always more important than product knowledge. You got to get them to like you at least, or feel that they can tolerate your company if there's a big layover at an airport and you're sitting beside them for hours. Are you likable? Integrity. Resourceful. Are you resourceful? And do you follow up? All very important. Okay, this is the last one. Interview crutch question number 7, relationship tips. Okay, explain X to me, right? If you have no idea how to, what the heck was that? How to answer that, right? Then here's some character tips for you, okay? I'll get back to you, crutch. Okay. So you can say, I'm sorry, but I don't know the answer, but I will get back to you. Okay. Then in your thank you email later that night, mention the answer. This shows that you're proactive and not a BSer. And I remember years ago when I interviewed at Goldman Sachs, God, it was late 90s. And there was a guy named Aaron. I remember he asked me questions about international markets I covered. And I said, yeah, I followed Germany as well. And then he asked me what markets, and I said the DAX. And then he said, what company? And I remember saying Daimler, Chrysler, or Mercedes. I can't remember. And he said, who's the CEO there? And I said, it was Jürgen Schrepp at the time. And then he said, well, what's their earnings growth? And I said, I don't know, but I'll get back to you. Sorry. Okay. And I followed up. And they like to see that. And this is an interview tactic, actually, that we used to use a lot. We would start high level and drill down deeper to see if they are, going to be at the high level of integrity and not BS you. Okay, because if they BS you, they'll BS clients, and you don't want that. All right, the other firm crutch is this. Okay, I'm sorry, I don't know much about company X. However, please let me know if you'd like me to discuss company Y instead. Thanks. So if they ask you about Uber, you can say, I don't know much about Uber, but I can talk about Lyft if you'd like me to, or I can get back to you with more comments. Okay, and they just want to see how you react. Okay. And again, if they ask you firmly and they're trying to intimidate you, don't get intimidated, okay? It's just a game. Enjoy it. All right, and then the other industry crutch is this. I'm sorry, but I don't know much about company X. However, please let me know if you'd like me to discuss this similar industry instead. Thanks. And they'll probably say no, and then you'll say, I'll get back to you. Okay, and then your follow-up email that night, thank you very much for your time, semicolon. I enjoyed our conversation. Regarding your question on industry X, here are my thoughts, and keep it brief. Remember, less is more. Every word you write in an email costs you $100. You got to pass the O'Hare test as well. Remember, O'Hare is one of the biggest airports in the world. And so if you're stranded there with this person, do they like you? Can they tolerate you? Are you enjoyable? Do they trust you? That sort of thing. I want to work with people always that I like and enjoy being with, because unfortunately, you're going to spend more time with these people than you will your family, at least initially.